Imagine waking up 5 years from now and the property you bought in 2026 had little to no growth. You've paid the maintenance, you've paid the mortgage, you've covered all these costs for 5 years and you've seen little to no growth. Well, that has been the reality for a lot of property investors in the past. And that's from the last time in 2008 when we had the last GFC. So what you had is people doing FOMO buying. That's when they're just buying anywhere and everywhere just to get into the market. In this video, I just want to go through the things to consider before you go and buy an investment property, and to most importantly, make sure you don't get stuck in this trap. So let me just play out a scenario for you. Option one, this person goes and buys a house and land package in the middle of nowhere, or they buy an off-the-plan apartment. And fast forward 5 years from now, it's growing, let's say 10%. So you've made 60 grand in capital growth, but along the way, you negative geared, maybe 5 to 10 grand per year. So you're really at a break even. And this is the reality that's actually happened for people, which I'm going to go through in some real stories in a moment. Or scenario two, this is when you done the research and you looked at areas where there was both high owner occupiers, but the biggest thing we're going to cover in this video today is there's scarcity. There's not an oversupply of stock. And because you've done the research, or it's not even a lot of research, you're then buying into a scarce location, which then gives you a 7% annualized growth rate. So what that means is if you bought that property for $800,000, fast forward 5 years, it should be worth $840,000. If you bought it for $600,000, fast forward, it should be worth $840,000. That's $240K in uplift. So these are here's a couple of real world scenarios. So just last year, I helped a first home buyer buy an apartment in a suburb called Fortitude Valley in Brisbane. A lot of people would know about it. And it was an apartment in the FV Peppers estate. So what happened was the person that brought this 2-bedroom, 2-bath apartment, they paid over $700,000 for it back in 2009. So that was just after the GFC. We ended up buying the 2-bedroom, 2-bath townhouse off that buyer who held it for that more than 10 years. We bought it off him for $650,000. In hindsight, in the last 12 months, it's had crazy growth. They're now selling for $800K. But that investor, they found their exit. They found the time to finally offload the stock, even making pretty much no money, and they got rid of it. So that's a horrible scenario, and that's a real world scenario. I also, when I started off as a buyer's agent, I was helping this couple. They were local. They wanted to buy their big home in Tarragindi, and they owned a 1-bedroom apartment in West End that they purchased, and they could not sell it. Like nobody would even buy it off them for the amount that they purchased it for, even for a little bit less. So they were stuck with it. But now, fast forward now, it's, they've gone up in value. But that's the reality we are in at the moment. We are in a similar situation than we were back in the GFC, where prices are hitting all-time highs. So you really want to be careful, and you want to just do your research so you don't get stuck in these situations like these people did. And it was purely because, someone sold them an off-the-plan apartment. Those two scenarios are very straightforward. Somebody bought an off-the-plan apartment, which is happening right now. There's a ton of apartments coming up. If you're the person that gets stuck with $1 million apartment when all the other ones are selling for $800K, you're going to get stuck in that scenario where you have almost little to no capital growth, or you can even go backwards in value. So what we want to do now is we want to break down 3 bullet point strategies for looking for areas that have a scarcity factor to it. And what I'm going to do is I'm going to share my screen, and I'm going to run you through one of the first items, which is the building approvals. So what you can do is you can use a software called Stash. There's plenty of other softwares out there, but there is You've got data house software, so you've got H tags, suburbs finder, and stash, and they've got these cool little overlays. So in this one, I've got building approvals, and this is Brisbane City Council. So as you zoom in, you can see in the middle of Brisbane, it's quite green. There's not too much stock coming through. Looks like there's a bit of stock coming through out in Newstead and Bowen Hills. This would have to do with all the new apartments coming through. And then Wollongabba, you can clearly see a lot of apartments coming through. Where this really starts to get interesting is when you go to these outer ring areas. So it starts to get quite red, and red is a bad sign. Green is good. But we can get out to areas like Greenbank, where there's a massive supply of land. Areas like Yarrabilba, which is a massive supply of land. And then finally, you've got Flagstone. So these areas look great on paper. You can get it nice and cheap, but half the time you can actually buy a brand new home for the amount as an existing home. So when you've got that imbalance, that's where you start to dig a little deeper, and maybe you're better off going in one suburb in to an area where it's more scarce and it's more landlocked. If we head over to Melbourne, we've got the same scenario. If you head out to the Western corridors, you can see areas across Werribee, Hoopers Crossing, Tarnet in particular. Look at that, 10% in building approvals. These are areas you really want to be cautious and you kind of want to avoid at this stage of the property cycle, especially if you're heading to areas like Melbourne. They're in the earliest stages of it. And then when you get out to the Eastern Corridor, you can head down to Office South, and then you've got all these little outer area suburbs. And then if we go up north, I'd have to say suburbs like Beveridge, you just want to be very, very, very careful for. But if you go to Craigieburn, you'll be pretty good. So another aspect we want to look out for is our owner-occupier ratio. So as long as building approvals are sub, we'll call it 2%, you can see that they're going to stay in the green. But we want to look at how many properties are owner-occupier. So this is a very important metric, because what you'll find is that areas that have less owner-occupiers and more investors, they are areas that are prone to, when the market pulls back, these are areas where, say, an investor owns a family home, and we'll call it Sydney, and they own an investment property up here in Brisbane. Before they go and sell their family home, they're going to sell their investment properties. It's just the reality, and that's something you really got to think about when we have a downturn. These areas that have more investor focus, that's the areas that will get flooded with stock, and people will start to sell them at a discount. So if we start to look, a lot of Ipswich doesn't look the greatest, but they are starting to come down. They were quite red about a year ago, but now all that stock's been eaten up. So it's not as bad as you think. I believe some of these areas have to gentrify, but you just want to be very crystal clear on it, because there's some areas that have a lot of, like here, look, Woodridge has 43% owner occupiers. That means 60% of the stock is investor focused. That means when the market pulls back, Woodridge is one of those areas that is going to get smashed, and they got smashed in the last cycle as well. So if you know that, if you overlay this with the Housing Commission, you know that this is an area you want to stay clear of. Again, if we head over to, we turn that overlay off, we then will start to cipher our suburbs that we want to select to more owner-occupier suburbs. So, Werribee doesn't look too bad, but then you got Tarnet and all of that. They look good on paper, but once you overlay it with the owner-occupier, once you overlay it with the building approvals, it starts to look quite bad. But you get up to areas like Kurrajong, Long Forest, Milton West. These pockets are more desirable for families, and these are the pockets we want to target over areas that have lower amounts. So it's a matter of looking at these key data points and a number of other ones to first of all make sure, hey, there's not too much buildings that are going to come through and flood the market. And secondly, when the market pulls back, there's not going to be everyone selling their properties to then reduce the value of my property. Because if people start selling at discounts, unfortunately, your property is the one that suffers and your capital growth goes down. And then it means that you can't leverage that asset to go on to get your next one. The last thing we want to look at is we want to look at our infrastructure spending. So infrastructure spending is something you can check by using hotspotting.com. You can even just jump on ChatGPT now, and it's pretty savvy. It gathers information off the internet, and it can run you through what infrastructure is going where. But, you know, Queensland in particular has a lot of a bulk of the infrastructure that's going in. Melbourne's already got really good existing infrastructure, but there are new hospitals and new infrastructure going in within areas like Milton and near Werribee. So just being a bit more savvy with, you know, double checking what infrastructure is going in, because if you're buying somewhere where there's an oversupply, there's not much money getting spent, so there's not many people moving in. It's a bit of common sense, but infrastructure is last on the list because, you know, I think you should check building approvals first, and you should check the owner occupier to investor ratio before you go in. But if you did want to just, you know, shortcut looking for, you know, where the hotspots could be, you know, jumping on ChatGPT. I've built a free ChatGPT that you can use, or you can go on websites like hotspotting.com. They build reports. They're about $500. That can be quite expensive, but just making sure that there's infrastructure going in, because that will dramatically drive capital growth. Where the money flows is that's where people will go, because it's going to create a lot of jobs. And it's just always, it just shows that what happens in Townsville showed what happened in Cairns and Rockhampton, because everyone knew that infrastructure was going, and we're able to target there, and we're able to get insane capital growth off the back of that. So really, to finish up, you know, this investment property you buy can shape your financial future. Don't just go blind, and really, you know, coming back to it, you know, don't just buy property for the sake of buying a property. Do a little bit of research at least. You can use ChatGPT now to answer a lot of these questions. Use it as a coach, and make sure you're going and you're buying the right suburb, because even if you know, overpay just a little bit, you'll be much better off than buying a discount in a suburb that's not going to grow.